Okay, so we'll get started. Good afternoon. I want to thank everyone for joining us today to talk about buying in this current real estate market. I want to also thank you for trusting the Mark Boyland team at this crucial time. Just a couple of housekeeping notes. This webinar will be recorded, and we will be sending it out to all attendees in the next day or so, and we'll be reposting it on Facebook and those types of things. At the end of the webinar, we will be doing a Q&A, so please use the chat icon at the bottom of your screen to type in your questions as we go along, and we'll answer them at the end of the presentation. So please look for the chat button if you have any questions. So I'd like to start off by saying I appreciate and respect what everyone has been going through in the last couple of weeks. It's certainly been a wild ride for our business and our families. As many of you know, real estate brokerages were deemed non-essential about 2 weeks ago, so we could not do showings, you know, traditional open houses, have listing or buyer consultations in person with our clients. So effectively, we were shut down. Since that moment, it has been all hands on deck for our team, and we've been working around the clock, you know, on ways to help our clients continue to move their sales forward, but in a safe manner. And certainly the change in the laws is coming fast and furious. The change in the information is coming fast and furious. So as we've been developing our talk for today, we had to keep changing it. We thought we had it set, then something new would happen, and you know, we'd have to change it. And maybe by tomorrow, well, probably definitely by tomorrow, something else will have changed. But on Wednesday night, the state reversed their decision and made us essential, so we can now operate in a limited and safe capacity. They still have some restrictions, and I'll get into what we're doing there a bit later. Now, I know a lot of people have been coming on the webinar, some at different times, so I may repeat myself about the chat feature. If you do have questions, just use the chat feature at the bottom. So let's, and we'll get into those answers, the Q&A at the end of the webinar. And I have muted everybody just to make sure that we don't have any background noise during the process. Okay. All right. So for those that may not know me, because we did market this out to a lot of people on different platforms, my name is Mark Boyland. I'm a realtor with Keller Williams Realty. I've been in the business for about 25 years, and just want to say I have an amazing team of 18 people that I get to work with every day. The great thing about them is that they work tirelessly, they care about our clients, and I'm proud to be in business with them. Last year, we helped more clients buy or sell real estate than any other team or agent in our 7,000 member MLS. I'm also on the board of managers for the One Key MLS, which is the fifth largest, excuse me, MLS in the country. So, which really helps me give me a great perspective on a regional basis. And this is not my first rodeo. You know, since getting into the market in '95, which was also a shifting market, went through the most recent housing crisis of 2008. And in 2009, in addition to selling real estate, I traveled around the country, and I trained about 1,500 agents on how to help their clients in that difficult market. And there's some components of that market that are similar to now. Obviously, the speed of which things had changed. But I do believe because of the mindset and experience that I got out of that transition, we're better prepared this time to go through the current one. Though I do want to make sure that it's clear that from a real estate perspective, this shift is not like 2008. The housing market is in much better shape and more prepared than it was last time. And, you know, so we're going to get into why this is the case. Our guests today who are joining us are Alan Lichtenstein. Alan's a real estate attorney with over 40 years of experience, and Peter Kulka, who's a senior loan officer with Greenway Mortgage, just to give a perspective on what's happening in the legal world right now and what's happening in financing. So, and there they are. I gotta do this at the same time as talking. So, what I'd like to do is just quickly go over the points that we'll be covering today. First, talking about the market shift and comparing it to other shifts of the past and the current one, so we'll get into the differences between those. Two, what we're doing to adapt and innovate in order to help our clients in the shifting market. Three, what are the potential opportunities and even the potential challenges in this market right now. And then lastly, we are going to do a Q&A. So we'll answer your questions on, that apply to you specifically. So we want to make sure we get all of that. Okay, so let's get started with kind of market shifts then and now, and why I feel we're in a better position this time than say in 2008 or with some previous changes in the market or previous recessions. For one thing, interest rates are significantly better than they've ever been. So when we look at, for the last 50 years, the 30-year mortgage rate has moved in unison with the 10-year Treasury rate. They're not exact, but they do generally move in unison. And what we can see most recently is that that 10-year Treasury rate and that 30-year fixed mortgage rate is historically very low. In fact, the lowest numbers in quite some time. So I know you've heard about the Fed funds rate being 0%, and people are asking, well, why aren't interest rates at 0 or just above that? That's very different than the 10-year Treasury. The mortgage rates are not tied to that. So that's why you're not seeing rates that are even lower in that respect. But just to kind of quote the Deputy Chief Economist of First American, he said, as evidenced by recent events, often the spread increases because mortgage refinance applications processing capacity cannot meet demand. So basically, the rates are so low, there's so much demand coming in for those rates on refis and purchases that basically the demand cannot be met. So while the mortgage rate has declined in response to those yields, it's unlikely to fall by the same magnitude as a Treasury yield. So it's plausible that mortgage rates could fall further if the benchmark 10-year Treasury bonds yield declines further. It's reasonable to expect that rates will fall even further and likely surpass the prior record low, but not necessarily one for one with the 10-year Treasury yield. So we could theoretically see lower rates once that backlog of processing ends. But what we can see from March 5th of 2020 is that hit an all-time new low, 3.29 on a 30-year fixed rate. Now that's come back a little bit, and that's due to mortgage throttling, where lenders, because they can't handle the increase in volume of people wanting those low rates, tend to position the rates higher to slow down that volume, or maybe even take better profitability during that. So once they get through that backlog, you may see rates start to come down some more. So how has this housing market been impacted by previous stock market crashes? Well, it's interesting. When we take a look at the period between 2007 and 2009, let me add somebody here. The S&P, that correction, it dropped 51%. But if we took a look at the same period for home price depreciation, we didn't see anything that dramatic. So when you look at 2007, 2008, and 2009, the total depreciation over that period was under 20%. So I just want to make it clear that just because the stock market is falling by a certain percentage doesn't necessarily mean that houses prices are going to depreciate by the same amount. And when we take a look at the .com and 9/11 crash, very similar. We had a 45% reduction in the S&P, a correction there between 2000 and 2002. But surprisingly, between the same period, we had annual home price appreciation that went up 8.6, 6.6, and 8.5%. So I want to make it very clear that just because the stock market may be down does not necessarily translate, or just because we're going into a recession or in a recession, doesn't necessarily mean that we are going to see home prices depreciate by a lot going forward. If we take a look at major pandemics or epidemics, this is looking at what the National Association of Realtors put out. We look at an annual existing home sales after 9/11, after SARS, or H1N1. You can see that the number of home sales in some cases actually increased or flatlined. So there wasn't any big drop after these major pandemics or epidemic events. There was a drop, as you can see, from 05 to 08, but that was a housing-driven crisis. That was not, any other financial, economic, or pandemic crisis that was contributing to that. That was really built from that house of cards that the mortgage industry had set up. And we look at median prices in existing home sales. Once again, prices even after 9/11, SARS, prices were still going up. H1N1 prices did flatline, but you didn't see any dramatic downturn in prices during or immediately after that. So bottom line, recession does not equal a housing crisis. And when we take a look at what Bill McBride said from Calculated Risk, with the sudden economic stop and with many states shutting down by closing down schools, bars, and restaurants, my view is that the U.S. economy is now in a recession, which started in March 2020. And GDP will decline sharply in the second quarter, as Goldman Sachs is forecasting, and the length of the recession will depend on the course of the pandemic. All right, so what he's basically saying here is the length of this recession is going to be very much tied to how long this pandemic goes. So once the pandemic starts to ease back and different regulations are lifted and everybody kind of breathes a sigh of relief, you are going to see GDP growth happening. So when they're predicting right now from Goldman Sachs is that we're going to see about -5% GDP forecast for the second quarter, but the third quarter and fourth quarter, obviously this is predicting based on their models of when the situation with the virus will end, is looking to go up either 3 and 4% depending on the quarter that we're in. So that's pretty significant, and they're predicting further strong gains in early 2021. Wells Fargo saying we don't expect a repeat of the severe recession of 08 and 09 because the virus and oil shocks are not endemic to the financial system, but are rather external. So once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and especially into 2021. So we do have this potential positive news on the back end of this. When we look at the last 5 recessions, which is pretty interesting, 3 of the last 5 recessions actually saw an increase in home price changes. The 2 that where it went down were mostly attributed to the housing market. Obviously 2008, that was all housing that pushed that recession. So it's not surprising that the housing prices dropped by about 20%. So just because we're having a recession, once again, does not necessarily mean we're going to have significant house price changes. Now, will we see a number in the rise of foreclosures? I've been getting this question a lot. And here's the interesting thing. Federal Housing Administration indicated it's enacting an immediate foreclosure, immediate foreclosure and eviction moratorium for single-family homeowners with FHA-insured mortgages for the next 60 days, and Fannie Mae and Freddie Mac are going to suspend foreclosures and evictions at least 60 days. In New York State, they've actually, they're pushing for a 90-day moratorium. And here's the interesting thing. 2008 is very close. It's right in the rear view mirror of government and banks, and they have processes that were put in place then. They have the experience. The people working there were there then, so they're much better prepared to handle people who are going to start missing their payments than they were last time, where it was a complete and utter shock for the system. So they're already getting ahead of it, which means that we're going to have a much softer landing with this process. They don't want to have mass foreclosures, mass short sales again. So we believe that they will be ahead of that. And then next, the big difference between then and now is back then, 05, 06, 07, homeowners had pulled about $824 billion equity out of their homes through home equity lines of credit, and they use that money for all sorts of things, to fix up their house, travel, college, luxury goods. Obviously, a lot of those decisions were not well thought out, and the banks were just willing to lend that money. So they pulled $824 billion out of their homes, so when the market turned, there was no equity there for them to cushion them. So that led to more foreclosures and short sales. But if we look at now, 2017 through 2019, we're at about $232 billion of equity pulled out of people's homes. So there's a lot more equity in people's homes now. There's a lot more cushion now. Obviously, the banks have, not allowed people to take out as much from their homes. So I think that's a good thing. So last thing here, payment as percentage of income. Historic norm has been about 21%. So if you even go back a year and a half here on this chart, at the height, it was about 18%. That's pretty incredible. So even then, a year and a half ago, the percentage of payment as income, percentage of income as payment was below the historic norm. If you look at it now, as of January, it was 14.8%, under 15%. So that's pretty incredible. That means people have a lot more cushion in their payments than they've ever had. So just another reason why this is not going to be like last time. So let's take a look at showings in New York. This is pretty fascinating. When we take a look, the blue line at the bottom is 2019. The orange line at the top is 2020. And what we can see from there is that there were about 5 to 10% more showings on homes at the beginning of this year versus last year. What that tells me is there was much more demand growing. There's going to be a pent-up demand for housing coming forward. Obviously, that number of showings dropped off significantly once the laws were passed, the stay-at-home laws, but the potential is there. These people, once things shift, they're going to be getting back into the market. So before I go any further, I just want to get a sense from Pete Kulka from Greenway Mortgage. What are you seeing in the market right now as far as financing goes?
Yeah, thank you, Mark, and good afternoon, everybody. You know, what Mark said earlier in his presentation is absolutely true. If you look back just about a month ago, rates were at an all-time low, and we got flooded with purchase opportunities as well as refinance opportunities. And that's what, in essence, drove up the rates. The bank tried to stem that activity by pushing rates up a little bit. So what we're seeing is not fundamental issue with the banks like we saw back in 2008, is specifically tied to what's going on right now. What we're seeing right now, though, is the investing community that buys these on the back end after we are all done with the process is really focusing on tightening up credit requirements to some extent, and especially lately over the past couple of days with what's been going on with folks filing for unemployment, the real concern is taking a good hard look at verification of employment. Is that borrower or is that individual's income likely to continue? So you'll see more heightened activity in checking that as the process continues. But fundamentally, we feel the same thing that Mark just communicated, was that the fundamentals are still very, very strong. And after we get through this pandemic, who knows how long that'll take, I think we'll see a pretty rapid bounce back. Right now, rates for somebody with excellent credit and with a conforming loan balance of about 510 or under, I looked just before the call, rates are in the mid-threes, about 3.5. So we are going to snap back, I think, quickly once we just get through all this uncertainty, which has everybody unhinged a little bit.
All right. Thank you, Pete. And Alan, what are you seeing on the legal side of things right now in today's market?
Well, right now, the things that we went into contract in January and February, they're starting to ripen. A couple have dropped off, the vine and got lost because of problems. But there's still a lot of activity in trying to get things to the closing table. Surprisingly, we're gaining new work every day. And it's not work where there's owner financing or anything fancy. People are still going to, conventional lenders, banks, mortgage bankers, and we're seeing a flurry of activity. Part of it may be that there are people who are now trying to get out of urban areas and come into suburbia or exurbia, where, which northern Westchester is. So I believe that there may be some pent-up demand and an effect of people trying to flee the city and come up here. I'm finding that I am also finding that things are going slower. There are logistical problems. We've had to, we use things that we've always used, like DocuSign, Adobe Sign, remote signing. We have a table out in a room that nobody uses where we can let somebody in and let them sign things. I had somebody sign a power of attorney out on the garbage bin one day. I left it there for her, and I stood away, and she signed it, and she left her ID there. She brought her ID. So we're doing things that where they're a little more innovative that we didn't do. We're doing mail-away closings where we don't actually attend closings. We send things in escrow. So things can get done, but you have to, be willing to spend the time to do it, and you have to be working every day. You can't look at this opportunity as a time to spend time home with your kids and stuff, and play with the kids. It's okay to be home. You should be home, but you should be working, and there's definitely opportunities and for both buyers and sellers.
Mm-hmm. Okay, great. Thank you. So what I want to talk about next is what are we doing to adapt and innovate in order to help our clients in this market? So one of the things that we're working on or have put in place are virtual buyer consultations. So we're doing them through Zoom and other e-conferencing methods. We're doing e-sign documents where our clients can sign documents electronically. We're doing 3D tours of our listings and requesting virtual tours from other agents' listings. And we're also doing 3D virtual showings. We put together client care hygiene kits, so we have gloves, booties, and we will be getting face masks on Monday for not only our team members, but also our clients if they don't have their own. We're doing no contact showings, and we're doing a program called Open Houses from Your Couches, which are allowing the community and buyers to look at our listings and do a kind of a traditional open house where they can walk through the house, but guided through one of our team members to answer any questions that they have. And we're working with inspectors who also offer no contact home inspections and YouTube video walkthroughs. So just some of the things that we're working on, and we're always developing new things to allow people to move forward and purchase. Because the interesting thing is there are deals that are, or there are buyers and sellers that still very much need to and want to buy in this market for various reasons. So when we look at the last 7 days, there have been 420 new listings to go live in our MLS. We have had 444 properties go under contract just in the last 7 days. So keep in mind, these contracts went into place, you know, a week or two after, you know, all the virus news started to really get heightened and the laws were put in place. So these are new deals in most cases. We've had 173 homes with price decreases. So that may show that some homeowners are trying to get a little bit more competitive. Or maybe getting more realistic in the current market, and we've had 323 homes that closed. So obviously there's still activity going on out there. We put together 4 deals last week, and one of those deals was actually off of our 3D tour. We had the buyer walk through the home virtually. We negotiated. And then came to an accepted offer, all without the homeowner actually, the home buyer actually entering the home. So that's probably one of the first times we've certainly done that, which is pretty incredible. So this is just to take a look at what a 3D tour looks like. We start out with a dollhouse view, as you can see here. So a person can, you know, click on this screen and go into any room and then walk through the house on their smart device. If they have the Google 3D virtual reality glasses, you can also view it from here. It allows you to do a floor plan walkthrough. You can even measure rooms virtually in the system. So it's pretty incredible what we have here. In addition, we did purchase northofthecity.com. So we're going to be doing targeted marketing to the city to remind those dwellers of the opportunities that we have up here in Westchester and Putnam and Connecticut. And that we have backyards and lots of elbow room and space. You don't have to get into an elevator or a hallway up here. So maybe it's time to think about, you know, giving Westchester a look-see. And, you know, one of the things that I'll get into in a minute. One of the other things that we're doing, obviously, we're providing booties and gloves boxes at all of our listings. So if a buyer goes through the 3D tour, if we negotiate, you know, a reasonable price for all parties on the property, and they do want to take a look at it, we have a whole bunch of protocols we have in place to make sure we keep everybody safe. Obviously, having these booties and gloves and these protocol kits at the house are part of that. So I want to talk about, Pete, what the mortgage industry is doing right now to innovate and keep loans going, you know, while, you know, all this craziness is happening.
Sure. Well, Greenway has been set up perfectly for this. We're lucky to have a president who embraces and uses technology. So we're cloud-based, and it's really been one of the core tenets of our operational strategy since our inception. So we can work remotely. A lot of our communication is done in a secure environment through eDocs, as Alan mentioned. And really, we can conduct a whole transaction from beginning to end pretty much electronically. And the last part where you have contact is when you go to the closing table. But we also have a very robust website at greenwaymortgage.com that allows you to start the mortgage process online, upload docs, and that automatically interfaces with platforms that I work on, and then we can talk in a collaborative fashion about the data and start reviewing the information to conduct your pre-approval. At this important time also, if you go to that web page, which is greenwaymortgage.com, you'll see in the top of the page, there's a banner that says Incident Resource Center, which will keep you up to date on all the latest developments as it relates to the mortgage process.
Okay, great. Thank you, Pete. Appreciate it. And Alan, just same question. You know, what are you doing to adapt and innovate in order to keep, you know, your clients on track with their deals?
Okay, well, what we do is, you know, do a lot of things, you know, by telephone, still talking to clients, going through contracts. We do use e-sign for signing contracts, so you don't have to be anywhere near here. And then we instruct the clients to either wire or FedEx checks directly to the seller's attorneys if we're representing the buyer. What we do also is we try to set up when we do have to close, and I have done about 5 closings in the last number of days. What we do is we have multiple conference rooms. First of all, nobody's allowed at the closing who's not essential. Can't bring your father, which something I tried to do. Can't bring, you know, anybody else, just the participants who are absolutely necessary. Unfortunately, for the real estate brokers, that doesn't include you because we don't absolutely need you to close. Sorry.
That's okay.
But and Pete Kulka too. But we do separate people into multiple rooms. One of our conference rooms has an approximate 10-foot table. So what we try to do is put people on the long side, and we try to keep that room to 3 people. And then we have a smaller conference room where we try to put perhaps the seller's attorney if I'm representing a buyer. And if it's a title company that I use, there's one in my building that's still operating, and the title closer, who's one of the owners, doesn't really come to the closing. He just flits in and out from upstairs. So that's one less participant at our office. We don't have the title closer because he's on site and he works from his own office and just picks up documents as he needs them. So, you know, again, we've met with people outside. I anticipate doing some closings on picnic tables in the near future, and some things. I've closed on Chevys and Cadillacs in my day. So, you know, and I've closed in restrooms too in office buildings. So this will just be another phase going to a picnic table.
Okay, great. Thank you. So what are the potential, I want to talk about what are the potential opportunities in the market. Obviously there's some challenges, but just the highlights that, you know, we're seeing is if you're selling a home or thinking about selling a home, right now the opportunities are this. One, interest rates are still historically low, allowing buyers to afford more home or to purchase in areas they were previously shut out of. So there are buyers that want to get in this market. Some sellers out there, not all, but some are pricing more aggressively right now, or maybe more flexible, you know, due to concerns. So you as the buyer, obviously, can get possibly a better deal with some properties, not all. So there's that. You may have less competition at the moment from other buyers that are sitting on the sidelines. That's for sure. And if you wait until things are back to normal, you may lose out on those interest rates. You may lose out on the best flexibility in pricing. And then when things start to come back, as markets get more confident, as sellers get more confident, that opportunity may be lost. One of the big things I would recommend if you are thinking about buying right now is getting in the mortgage queue and getting your pre-approval or mortgage commitment as soon as possible, because I think we talked about that, Pete, right?
Yeah, it is very important to at least get through the pre-approval process and do the analysis and get in the queue. So people that I have in there right now, rates are changing literally day to day. We're checking them, and we have folks on our staff that check them with vigilance all day long to look for the right appropriate window to lock that loan. So it is very important to be in the queue because you can't lock it unless you're in the queue.
Right. Yeah, exactly. So yeah, definitely, if you're thinking about buying, you want to kind of take advantage of the low rates. Definitely get that done. So we're going to open it up to Q&A. At the bottom of the screen, there's a chat feature that you can click on and add your question, and we'll be happy to answer that. One of the questions we have is the moratorium on eviction. So if you're renting a property and you can't pay your rent, what's happening with that? Well, one of the main things is now the state's allowing those tenants to stay for up to 90 days, no eviction for commercial or residential tenants. Now, currently, though, from what I can gather from that, the law coming out on that, at the 4th month, the tenant would be required to pay all the back rent. My personal feeling, though, is by the time the 4th month comes, they'll either will be extending that, or they'll be, allowing people to work out some sort of repayment program with their landlords. So, stay tuned on that. Obviously, continue to pay your rent, continue to pay your mortgage if you have the ability to do so. It's not necessarily a free ride. I don't want anybody to think about that, but they are trying to get ahead of this with obviously the people, losing their jobs or having reduced income. Question I have for Alan and Peter: do you see any of the changes that we're going through now of doing these virtual closings and these workarounds? Do you see some of this sticking with the industry after the virus issues go away? I'll throw it to you, Pete.
Yeah, like I said, we operate and have been operating that way for years, actually since 2011. So being cloud-based, we're pretty much a virtual company. And with the ability and with the platforms that we have out there to do our pricing and modeling, collect data, and exchange data with customers and clients to do consultation, all that is done very much in a virtual manner right now.
Okay, great. And Alan, anything you think is going to carry over?
Well, I think there may be a continuation and maybe an increase in especially sellers not coming to closings, and maybe not even sellers' attorneys and just being available. I have a closing on Tuesday, and we FedExed all the papers out to the title company to hold an escrow, pending them sending us federal expressing us the monies that my client is due. All the figures are done, and of course you have to be available during the closing time if any issues come up. I think that's a coming thing. I know of this situation, or I know an attorney in South Carolina who used to practice up here, and the way they do things down there may catch on here. Nobody ever meets all together. What they do is just messenger everything around, and it's all done within a day, and nobody ever gets together. In fact, I've had remarks over the years of people saying, gee, we don't do it this way in California. We never saw the sellers. We never saw the title guy. We never saw anything. So I do believe that it's going to progress in that direction.
Right. And Alan, we have a question from Sasha. She was asking, can a legal closing session be conducted virtually on Zoom or another platform?
Not right now. The banks are not allowing that. I've represented a number of banks, including Greenway, and they're not allowing it. Wells Fargo put out a directive about that. And of course, it could change, but right now there's not. And people are getting a little confused because you are allowed to have certain documents notarized virtually, and there are certain requirements. But a lot of people, and if there are anybody who's looking in from out of the state of New York, those notaries cannot be done for people outside the state of New York. The principal, the person who is signing the power of attorney, must be in the state of New York. So if somebody calls me from California, wants me to notarize, I cannot do it. Normally, I can't go out of state. If I travel over to Greenwich, Connecticut, I cannot notarize a document. I'm not a notary in Connecticut. So,
gotcha.
But I'm not sure how that's going to work. There was an attempt to do that years ago, and it didn't work well. But okay, who knows?
And thank you. And Pete, Dan here has a question for you. He said you mentioned that you expected rates to spring back once the backlog clears. I assume you mean that you expect them to go back down to where they were a few weeks ago. Is that correct?
Yeah, they're very volatile right now, literally by the hours of the day. I can go in the morning, and then in the afternoon, the rates will be completely different. So I think most of it, and certainly all of it, is driven by the uncertainty of this pandemic. The fundamentals are still strong, and I think once we get past this, or there's some positive news as it relates to it, I think that we'll, as Mark mentioned earlier, we'll be back to The mid threes or even record lows, and we're anticipating third and fourth quarter to be very strong for purchase and refinance activity.
All right, great. All right, well, I want to thank Pete and Alan for getting on today, and everybody for joining us. If you have any questions that pop up or want to have a more in-depth conversation how this market applies to you or get statistics for your local market or your price point, please reach out to me. You can reach out to me at mark@markboyland.com or at our office phone number. But once again, thank you to everyone. Appreciate you coming out. We are going to have another webinar for sellers at 3 o'clock in about a half an hour. So if you're looking to sell or somebody who is, that would be a time to join on. Once again, thank you, everybody. Have a great week. Stay safe.
Yeah.